Good afternoon to most of you on the call today. Uh, for those of you joining on the West Coast, I guess good late morning. But welcome again to our webinar today on better risk management, tying stress testing to loan review. I've been around a while in banking and have been so enjoying working with the group at IntelliCredit since 2019, and frankly trying to blend some deep credit experience with enhanced technology. Most of you are familiar with our sister divisions. Quick Rate you think of as certainly a funding source. Our other division, Quick Analytics, which does focus a lot on public data or call report data. IntelliCredit's energy source, if you will, is non-public or idiosyncratic loan data at financial institutions. Since we've been founded only since 2019, we have had a good ability to, I think, work with banks and credit unions all over the country, coast to coast. Our largest client is about $22 billion West Coast financial institution, and our smallest is a Midwestern bank of 72 million. Our average asset size clients are roughly in the $1 billion range. One of the things that when we founded IntelliCredit, literally in 2019, we wanted to take steps to, from a post-booking credit risk perspective, tie three fundamental disciplines that I think are critical to post-booking credit risk analysis a little more in sync and tied together. Many of you have known we've certainly done the loan review. We do the portfolio analytics, which is on the same platform. And now I can report that we now even offer two options in terms of stress testing. So we're certainly this has been our goal since the beginning, is to try to put some more synergy, if you will, among these three very, very important disciplines that really tell us where credit risk may be going once we book loans. It all starts here, of course, and again, as I said earlier, IntelliCredit's focus is the energy source that no one else sees other than yourself, except a regulator in the throes of an examination of your bank or credit union, and that is your idiosyncratic loan data. That's your DNA. That's where we think so much of the art of credit risk management emanates from, which is the sense of where are hotspots emerging, where are trends emerging, and all of this, again, is typically in those so-called past risk grade categories. As you well know, call report information is more in the criticized classifieds. We say this all the time in our shop. If you wait until call report tells you you've got a credit issue, those horses are long out of the barn. So again, this is where we focus a lot of the energy around getting information from clients, is obviously through their idiosyncratic loan information. But first of all, this webinar is really about you. And I want to ask you to, if you will, and this is very, very simple. You can take out your cell phone and scan the QR code, similar to ordering at a restaurant. And you will activate this, no password required. But we would like a little bit of flavor about the audience today in terms of what your perspectives on both loan review and stress testing is. So I've asked the three general distinctions in loan review as to how you have loan review or independent loan review conducted. So roughly about 50-50 at this point. Third-party vendor, somewhat predominating. Not surprising. It's usually the much larger financial institutions that have totally in-house loan review. Okay, the next question would be just to say, how do you rate the effectiveness of your loan review? And again, these are anonymous questions, so nobody's being tracked in any of this. But just, again, I think we've had a decade or more of very benign credit performance. Loan review probably was looked upon to some degree as a bit of a checklist item. we certainly see it as far, far more emerging in terms of importance and a key part of your risk management strategy going forward. Okay, so an average score about 4.2. Again, we're looking here at post-booking. We're not talking about your credit policies or even your underwriting tools that you use, but what would you consider the two most effective post-booking credit risk lines of defense in your financial institutions today? We've got options of risk rating, past due reports, annual reviews, independent loan reviews, portfolio analytics, or stress testing. Pick two. Well, I do think I will have to say this because people know I have, as I've gotten a little bit of gray hair, I have opinions. I would be concerned that if past due reports are your primary, because one of the things we try to do, of course, in banking, particularly today, is try to anticipate either through loan product or industries that are facing higher stress points than others. But anyway, this is interesting that you do, but certainly delinquency reports are very critical, no question whatsoever about that. So let's talk, before we get into the specifics of either loan review or stress tests, I'm a big advocate of always just trying to retouch the lay of the land and understand, what is the credit environment as it says right now. But again, in the spirit of trying to elicit your opinion, how would you, this is just a classic word cloud, you just punch in 2 or 3 words in here. How would you describe the current credit environment? Strong, weak, uncertain, that type of thing. Sometimes people are there we go. Here we go. There we go. Yep. Yep. None of this is surprising. I think it has been a bit of a sawtooth in the last year or so. We're so captivated, as we all know, by the financial press in the United States, which I think we'll all agree is very tied to Wall Street, very tied to quarterly performance. And I think all of us on this webinar know that credit, and particularly the financial institutions credit world, is a much longer term play than what the financial press tends to be. So we kind of react quickly to either a sense of either rates are coming down or unemployment's coming down or inflation's going up or down, and all of that can kind of trigger a little bit of a different perspective on a short-term basis. But yes, these uncertainty, I think, has been the cardinal word, frankly, since we formed IntelliCredit, even pre-pandemic, in terms of what we're not quite certain where it's going to go. Okay, these are some of the issues that we certainly see through our awareness of our clientele and working with clients on loan review, and that is the metrics still remain relatively good. They really are. But certainly dark clouds have been emerging of late. The servicing and while the underwriting is about as good as I've ever seen it in the industry in my long career, the servicing or the monitoring internally, it still is somewhat spotty. There's no question that the higher rates and the inflation environment have begun to take tolls on borrowers. That's no longer theoretical, it's true, we're seeing it. There is a bifurcated circumstance that we live with our consumer borrowers, partly divided definitely between kind of paycheck to paycheck versus the more well-heeled 401k kind of consumer. But certainly small business stress is beginning to grow along with some of the consumer stress that we've seen in terms of heightened delinquencies. There's no question in our mind, in the last 6 months, we've seen more recommended downgrades through our work in loan review than we've had in the past decade. Most of these, fortunately, have been downgrades within the so-called pass categories and not not a wholesale move towards criticized or classifieds. But there's another piece of this that I think that is important, and that is larger institutions have been growing their reserves at a pace a good bit greater than some of the smaller ones. And that has a reason for concern. In a moment, we'll share that. But one of the reasons that credit is such a long-term play versus some of the quarterly, Wall Street focus is that we've still arguably got $1.5 trillion of CRE repricing ahead, estimated before now and the end of 2025, which is inevitably going to have some further degradation on particularly debt service coverages. And again, one of the things that is most concerning to us, and I think it has to be on probably most of the people on this webinar, is that the smaller institutions' loan growth has been very heavy in CRE even since the pandemic, while all other national providers of credit in the CRE world have been shedding or reducing their exposure to CRE. A specific example, some of you may have recalled seeing this in another presentation. If you look at the chart at the very top, the bar on the chart, a little dated, but just still reflects post-pandemic, is that the only segment of credit providers in the U.S. Still growing CRE seems to be the smaller financial institutions. Even as of the first quarter of this year, all banks grew CRE up to about 2.4%. Community banks were still at a pace of 6.7%, according to the FDIC. Why this is again concerning, and I think why it's concerning only in the sense of trying to tell our clients and the broader group of banks and credit unions, be prepared for far more scrutiny of what you're doing, particularly if it happens to be in a concentration that's getting all the headlines like CRE. But here, as you can see, and these are numbers admittedly from just the commercial banking system, but there are also banks under $10 billion in assets. It shows a general decline in reserves since a couple of years ago peak. The larger banks, on the other, as I alluded to, the allowance for credit losses, which is the new terminology under CECL, has been increasing, while community banks have, again, somewhat declined. And again, all that's juxtaposed to the fact that we're growing CRE exposure at some of the smaller financial institutions. Inevitably, that's going to put a bigger bullseye on smaller institutions' need to explain their comfort in growing a loan product that somehow, and I'm not necessarily worshiping at the altar of Wall Street, because my goodness, they've got their own issues about stumbling over bad situations in the banking world. We all know that to be a fact. But the reality is, perception is that some of the more sophisticated real estate investors have been shedding their exposure while the smaller banks have not, or smaller institutions. There's another piece of this that I think that relates to that kind of perspective between short-term and longer-term credit that we have to live with in the banking world, and that is obviously finally, the Fed lowered rates last month after a lot of anticipation. But there's an instinct, I think, to say, wow, we dodged the recession bullet perhaps, and we're on our way to lower rates. That may well be true, but the reality is, from an empirical statistical standpoint, our numbers show that typically non-performing loans peak anywhere between 18 and 24 months after the Fed stops raising rates, kind of alluding to that point of, where the financial industry is a big aircraft carrier. It takes a while to turn. Doesn't react just quarter to quarter. So we have to still realize that upwards of maybe 2 years of heightened credit problems may still be in the pipeline for us. So part of this focus, honestly, is that whole issue of heightened scrutiny by the regulators. And the whole point of this webinar, to some degree, I think, is to try to give you a heads up on that this indeed has changed. There is what I call more of a high tide aspect of the scrutiny. Most of it emanated because of the post early 23 bank failures. Those 5 banks that failed, believe it or not, equated to almost 483 bank failures during the financial crisis in terms of their potential impact on the FDIC insurance fund. That sent shockwaves, I think, through the regulatory community that they certainly did not want further contagions. The irony of all that is among those 5 banks that failed, only one very small bank in Iowa had really credit at the heart of its problem. There is no question that, as we said, having to defend heightened growth or continued growth in CRE with community financial institutions is going to require some more scrutiny. What we are seeing specifically is there's a lot of focus on CRE management at financial institutions with a really strong emphasis, not on the 100, 300 guidance that banks have been used to in the broader sense, but on these subsets. What makes up those concentrations in real estate? Is it industrial? Is it office? Is it multifamily? Is it retail? Those types of things. And also trying to make sure not only are you underwriting your transactional credit opportunity adequately, but are you understanding the marketplace with its supply and demand dynamic as to whether or not it can absorb these properties that are being financed. There's no question that there's an increase in the so-called average classifieds to capital ratios that we're beginning to now see. As I said, the credit processes seem to be under the microscope. And some of that's in the eye of the beholder, we understand, but we're also beginning to see a little more focus on transactional credit. In other words, we're hearing more and more in the last couple of months where regulators have actually come in and increase their energy around moving credits to special mention or substandard, with a particular emphasis on primary sources of repayment. A consistent theme I've experienced in talking with regulators and with a client or two, but also they almost look at it from the standpoint now that, particularly given some of the pressures on valuations with some cap rate rising, is that the real focus has to now be on primary source. In other words, the ability to repay the loan, not on some kind of secondary collateral valuation backstop. There's no doubt whatsoever there are more MRAs or matters requiring action being administered by the banking, and not as aware of as much with the NCUA, but certainly with some of the banking regulators, we are certainly seeing heightened level of requirements that the board and the bank take specific steps to rectify some of what they perceived as some particularly process weaknesses. And again, I think there is, while I'm almost assured that no one on this webinar is actually required regulatorily to do, you're not CCAR, you're not DFAST financial institutions, but it's almost now a common theme that most regulators are saying, if we don't see it yet, we certainly expect to see far more robust and particularly loan level stress testing going forward. So what is the case for tying? And I was remiss in saying this at the beginning. This deck will be shared with all participants. I do encourage you, no one can hear. If you have questions, please use the Q&A function on the Zoom call today. I'll be glad to look at those and answer those at the conclusion of the presentation. So let's talk about the case for tying stress test with loan review, because they really are two different disciplines. Some of you have heard me speak to this in previous presentations. I won't go into a lot of detail about it, but it largely starts up at near the top. We're huge advocates of having only experienced people do and perform your loan review. I think this, particularly now, is the time to see loan review as a true partner of yours, an agent, an extension of your risk management capabilities. And frankly, I'd want someone who's kind of been there, done that, to see that. Not about to in any way disparage other vendors, but there are some, and certainly not all. Some of the larger accounting firms will send young CPAs out to do loan review. They, of course, understand the quantitative part of credit. They wouldn't be licensed CPAs without that. It's the qualitative or more subjective aspect of credit that I think often is the capstone for how credit is decided and frankly managed. That's where we believe strongly in, and I would encourage all banks and credit unions to ask for bios of whoever is going to be performing your loan review, particularly now that we're in kind of RFP season for next year's reviews. Take a look at documentation as well, and use a smart sampling from your loan information that kind of gives you, admittedly, a risk-based example. I had a conversation just early this week, believe it or not, excuse me, late last week, with a banker who said, well, I don't want to expand my loan review a little bit, almost, I don't want to know. I think that's a very flawed way of looking at it, because if I were kind of captain of the credit risk ship at a financial institution, I'd want to know as early as possible. Remember, there's a distinct correlation that's been proven over banking between the linkage between early detection and reduced ultimate credit problems. It has really been proven almost a universal truth now in our industry. Make sure you get robust information from whoever's doing your loan review, not just a chart that says we agreed with the risk grade. Again, we are big advocates of sharing that or finding some way to tie that to loan review, or excuse me, to stress testing. Again, encourage collaboration and, of course, use your technology to the best of your ability. Specifically, why I think it helps to compare or engage stress testing with loan review, it's really like killing two birds with one stone, because I think you've got the ability with loan review is you've got reviewers looking at files in real time, trying to opine on whether or not either original underwriting or even recent servicing is accurately describing the capability to repay the loans, or the broader risk profile of that borrower against an industry that they're operating in, or what have you. Again, it's that real-time perspective that I think kind of gives us a little more immunity from some of the data that may be a little stale coming off of your flat file. Again, it could be another just variant of what many of you use as what many of you call projections or sensitivity analyses that are performed in underwriting. And I do think the benefit to your board and your executive management would be that you get this kind of 1-2 punch of a good loan review, and you get a good stress test or credible stress test in one package. So what are we talking about loan level stress testing? You know, as I said earlier, probably no one on this webinar is fundamentally through regulation required to do one, but again, it's being asked of all of you almost across the board these days. The two basic divisions or distinctions in stress testing, of course, is the so-called top-down and the bottom-up. The top-down is really portfolio level. For example, our sister division, Quick Analytics, does an excellent job at taking public information, creating peer compare sets with your own particular financial institution. But that's call report data, that's public data. The bottom up or loan level stress test is where you basically get more of the idiosyncratic information about your bank. But knowing those two distinctions, I think, is important. I'm a big advocate of doing, frankly, both. They both have relevance, they both have merit, but there's certainly a lot of focus, and hence this webinar today, a lot more focus of late on the loan level stress testing. So again, that conjures up, at least in theory, what sounds great. We've got all this data. Many of you have excellent data mining, and much of that is getting more and more injected into your loan core system so that it can be data mined. But the reality of it is, like with any data, how consistent is it across all of your borrowers? How current is that? Something that was a loan that's 4 or 5 years old and you're still using data points of the original LTV or the original debt service coverage, is really rather specious in terms of any value about a stress testing. And again, how relevant is it? I think the solution, again, it's not a precise science, but it's certainly a workable solution, is to try to find credible proxies for these data. Question back to you. Knowing those primary distinctions between top-down or portfolio level and loan level, which is more of a bottom-up, what kind of stress tests have you had applied to your loan portfolio in the last year? Okay, go back to the scanning the QR code there. Okay. Interesting. Interesting divide here. Okay. So you all have had according to this poll, you have had the majority of you. Well, it's flipping as we speak. Interesting. So top down, again, most smaller financial institutions, top down or portfolio level has been proven adequate. But as we chart into a little more credit stress, as I think we all agree we are into now, there is seemingly a huge bias by regulators to strongly suggest complementing that with a loan level or bottom up, which is exactly where IntelliCredit is. That's what our kind of bailiwick is, and that's what I'd like to share with you today in terms of what we offer, but also what I think the industry hopefully has with other alternatives, other alternative vendors. So what we're going to talk about today is two distinctly different methodological approaches to loan level stress test. One is the more comprehensive. The other is as I said, companion with loan review, and is tied to the ability of the loan reviewers while we're in the loan review engagement to make real-time adjustments to things like LTVs or debt service coverages. So, but this first methodology is the more comprehensive one. It is, and it can be performed in any time. It doesn't have to be done contemporaneous to loan review. But some of the key attributes, and of course, it's like any vendor's stress test, there's going to be some, proprietary aspects to it, but I certainly owe it to you all to, I think, just share some of the broader issues that or attributes that we have. We think it's really, it's a big investment in what I think we've moved away from what was the predominant way of doing either credit marks or stress tests at the end of the financial crisis, 12 or 15 years ago. And the things we for example, we would need just a single loan file. It really eliminates the need for a lot of look back studies, which was so laborious during back in the day. It uses what is, post-Basel methodology, which many of us, of course, familiar with, the probabilities of default and the loss given default methodologies. And it is more granular assessment of risk in your portfolio. It's comprehensive in that we do look to segment risk through risk cohorts, through different types of loan products and loan segments. They can be customized to your bank's performance or your financial institution's performance, and some of that is somewhat qualitative in nature, but it still provides that. It also, being a stress test, it certainly does need to talk about kind of a baseline, midpoint, or high stress level and its impact on capital. And I do think, from a practical standpoint, it does offer you, in the end of the day, what are the credits, what are the borrowers that under this type of stress would you need to be kind of putting at the top of the front of the line to be scrutinized or keep an eye on. Again, the heart of this more comprehensive stress test involves the methodology of computing a probability of default and loss given default. The product thereof, of course, is your loss percentage or your so-called estimated loss. What we have done, again, to try to get away from the total fixation that was predominant during the financial crisis of nothing, the primary variable everywhere you turn was net charge-offs this, net charge-offs that. If you're visiting this webinar from anywhere from the Carolinas through Florida, you know full well that there's some banks, believe it or not, even as we speak, that are still in some net recovery from all the financial bloodletting or real estate bloodletting that occurred in the last crisis. That obviously, net charge-offs, really, it then becomes meaningless as of looking at credit risk in today's environment. Therefore, we've made a fairly fundamental change. We decided to focus not on net charge-offs, but gross charge-offs and write-downs. Make a very focused, rather than going back to long look-back periods and going all the way back to the last crisis, we like to look at what a bank has experienced in the last 12, 18, or 24 months in their credit performances and expand, if you will, that definition of default from just net charge-offs to, in addition to gross charge-offs, the heightened delinquencies, if you've had a non-accrual status applied, or foreclosures or bankruptcy. So we broadened the definition, if you will, of what a default would be. Again, the deliverables in this case would be where you would provide segmentation among your loan products, and then you'd have these probabilities of default, loss given defaults computed based on the risk cohort. There would be a baseline expected loss computed. Then you'd go into your stress scenarios, which in our case would be a midpoint and then a high end. Then you'd aggregate those between what we call the formula-based computations, and those are ones that fall pretty much in the line of where CECL is and so forth. And even though we don't have technically impairments under the new CECL as much as we had under the old ALLL, most of you still keep an eye on highly impactful or special reserved credit problems, and we still kind of generically call those impaired loans. And then, of course, we would need to extrapolate that to the capital account. I hasten to add, since there are credit unions on this webinar today, we are prepared to provide this methodology and the other methodology I'll touch on in a moment to commercial banks. It's certainly our goal to provide this into early next year in terms of what we can provide to the credit unions. The distinctions, of course, we have to align with NCUA protocols. For example, recognizing the distinction now between a complex credit union, which is above 500 million in assets. All of them require the net worth ratio at 7%, but if you're over 500 million, you have to go to a risk-based capital ratio of at least greater than 10%, or if you've opted to do the equivalent of the community bank leverage ratio, that's down to 9%. All of that, we're trying to make sure we focus in on the precise protocols that are unique to the credit union. So please realize that that is part of our strategy, is to make this available soon into next year. Other deliverables that you would be given, of course, is the expected losses. Again, simple or summary charts on it, impacts to capital. And then you would have a total portfolio broken down in the types of loans that you're looking at in the various categories of stress risk. We again treat the formula loan pools separate from the so-called impaired or specialized credit that you're keeping special reserves on, but we blend those two together to compute these losses. And then again, one of the things that we all know on this call and we hear is a complaint of why people frankly don't care that much to have to do a stress test. I hear this all the time. Well, they're nothing but theoretical exercises. I get all of that, but here's what we insisted on including. This kind of takes it from the theoretical to the practical, and that is, okay, for all those so-called theoretical impacts on either estimated losses have been calculated, and then how does that extrapolate to the capital accounts? I need to know who in actuality are the credits, the borrowers that I've got to keep an eye on should we actually get into the even more credit stress. And this, of course, would be, I think, an almost required byproduct of any credible stress test in this environment. So that's kind of the way we operate into the more complex, but I've mentioned companioning this with loan review in specific, and that is truly conjoined with the loan review engagement. As I said earlier, we've attempted to find proxies. For example, key assumptions or proxies to us are really three. It's kind of a three-legged stool here. It's loan to values, debt service coverages, and risk grades. We think of loan to values, people will inevitably say, well, where are cap rates in loan to values? Well, loan to value is a reflection ultimately of where cap rates are going relative to valuation. Debt service coverage, people always say, well, I don't see an NOI, I don't see an interest rate stressed. Well, a debt service coverage, once computed, is reflective of those subsets, if you will, of cost of borrowing. And then, of course, risk rating is a legitimate proxy. It should be construed that way, as a reflection of original underwriting and servicing of the loan. So those three, if you will, proxies we use to somewhat simplify this exercise. And it was frankly designed based on an FDIC white paper that came out in 2014 that would be quite acceptable for non-complex financial institutions. So the methodology we use there is, again, just to aggregate, assign a risk weighting based on your FIEC code or the equivalent of that with the credit unions, and then create a kind of pro rata capital account based on that particular loan product's fractional percent of the risk-based capital at risk under stress. And again, just these are examples of that type of deliverable. Again, you would have these assigned based on the loan product categories. Remember what specifically this is that we would have reviewers recalculating in real time the debt service coverage, the loan to value, and obviously the heart of loan review is the risk grading opinion, right? So you'll have those three key proxies covered in real time by the loan reviewers concurrent to the loan review exercise or engagement. You select the sample, you represent whatever, we've had I know a customer in New Mexico that has a huge portfolio of equipment loans, and we've done this type of thing in concurrent to the loan review engagement there as well. You select a scope, and again, we do this in conjunction with the loan review itself. And you see examples of that, and you would get specific stress kind of in a pre-stress and a post-stress impact on your risk-based capital by the products by which you've done the stressing. And then we use some of the quick analytic data to do some more public comparison as to how you are performing. And that has, again, proven a good add-on, particularly for non-complex financial institutions. And it shows good faith that you're doing that. And it blends, of course, as a companion report to your loan review report. And not unlike the more comprehensive methodology that I spoke about a few moments ago, of course, what we offer at the end is to make sure you get a by name and borrower, what are the credits, at least under stress, would probably be ones that you'd need to keep an eye on. So what should I do in conclusion? I think, I'm a big advocate of doing both a portfolio level, because that's the one that gets you a comparison to your peers. And that's what the outer world sees you, whether it's an investor or a regulator. They tend to see it in that lens before they would ever see anything that was on a loan level basis, which again is based on your idiosyncratic non-public data. Again, now that we can offer this, we have the two different methodologies. So again, we tried to do this in such a way that doesn't require these extensive look back periods where you've got hundreds of months of loan data to have to be digested. We can just do this strictly with one most recent flat file or extract from your loan portfolio. I'm a big believer that this is now part of the expectations of regulators. It's what I would call the new normal, and that is that irrespective of your size as a financial institution, it is clear from our perspective that stress testing is now almost as expected as loan review itself, independent loan review itself, in terms of a part of a risk management protocol. So I have enjoyed being with you today. I don't see any questions in the Q&A. Again, we like to think this is a way to do what I alluded to at the beginning of the webinar, and that is bring three of these very, very fundamental aspects of post-booking portfolio risk management together and a little more in sync. We would be glad to talk with you, of course, about performing any aspect of this, as well as, of course, your third-party loan review. So again, if you the deck will be sent to each of you, and I do see one Q&A here. How much is the AI being used? We do not use AI at this point. I remember attending a ABA national convention 15 or more years ago, where at the time the guru, none of us would have even known what the acronym AI meant, but I remember him using it, and he said, I will say this to the lifetime of virtually everybody in this room: AI is going to be massively important. But he said, I can't imagine, particularly those of you in the risk business, ever not having a human judgment call at the end of the line on that. And I do know there's still regulatory concern that's afloat out there around how do you integrate third and fourth party vendor AI into bank data information. So we aren't there yet. Again, much of this comes, frankly, from our experience of knowing where credit trends tend to perform. But at this point, I'm not in any way disparaging AI, because I know it's like you can't fight City Hall. It's going to be here the rest of our time in banking. But we don't incorporate that at this point. Hope that answers your question. But again, this has been a pleasure to be with you. I hope that we will be having a coffee talk on the 25th to further discuss this. And coffee talks with us, as you know, are much more less formal presentations, and we strongly encourage more participation from our participants. It's really a more of a casual conversation than it is a formal presentation. So we'll be having that on the 25th of October. Again, unless I see another question in the Q&A box, I'll certainly just want to thank you, as always, for allowing me to kind of share my thoughts with you. And we look forward to hearing from you if we can in any way be of any assistance. Thank you so much.